Welcome back to TaxSimplifiedAU. Today, we're diving into an important topic for landlords and property owners: rental and rent-related income. Whether you own a rental property, share your home on a platform like Airbnb, or co-own an investment property, this video will help you understand what needs to do into your tax return and why. So grab a coffee and let's get started. First, let's define rental income. Rental income includes all the payments you receive or are entitled to receive when renting out your property. That's not just the monthly rent. It also includes associated payments like rental bond money you're entitled to keep, letting or booking fees, and even reimbursements from tenants for repair costs. But here's the kicker: rental income isn't limited to cash payments. If your tenant pays you in goods or services instead of money, you still need to include the market value of those goods or services as rental income in your tax return. For example, if a tenant offers furniture in exchange for rent, you must report the fair market value of that furniture. Let's talk about rental bond money. You don't include it in your income just because you're holding it. But if you're entitled to keep it, for instance, because the tenant defaulted on rent or caused property damage, then that amount must be included in your income. Keep track of these details so you're prepared when tax time comes. Here's another scenario: insurance payouts. If you receive an insurance payment to cover lost rent, that money is considered rental income and needs to be included in your tax return. This rule ensures all income tied to your rental property is properly accounted for. Associated payments are any amounts you receive as part of the regular ongoing activities of renting out your property. This includes letting fees, booking fees, and reimbursements for deductible expenses like repairs. For instance, if your tenant pays you back for a repair you claim as a deduction, the reimbursement must be reported as income. Now let's talk about co-owned properties. If you co-own a rental property, how you divide income and expenses depends on your ownership structure. Joint tenants split income and expenses equally, regardless of who pays for what. Tenants in common divide income and expenses according to their ownership shares. For example, if one co-owner holds 80%, they report 80% of the income and expenses. It's important to note your legal ownership determines how rental income and expenses are divided. Even if you and your co-owner make an agreement to split things differently, that agreement doesn't change how income and expenses are reported for tax purposes. What about rebates? If you receive a government rebate for a depreciating asset like a solar hot water system, that rebate might need to be included as income. Always check the rules or consult a tax expert if you're unsure. And that's your quick guide to rental and rental-related income. From bond money to insurance payouts, understanding these rules helps you stay on the right side of the tax office while maximizing your claims. If you found this video helpful, hit the like button, subscribe to TaxSimplifiedAU, and share this with anyone who owns or rents out a property. Got questions? Drop them in the comments and we'll get back to you. Thanks for watching and see you next time.